All right, so we are going to address some questions and objections. Specifically, we are going to focus on the FUD in the life insurance industry. FUD stands for fear, uncertainty, and doubt. I did not come up with that term on my own. I actually got that from someone we work with that I value his opinion very much so. So we're going to address 5 objections and questions, kind of a combination of both. Let's get into them. Number 1, an objection and question we hear frequently is that we should have a high base premium, or one should have as high of a base premium relative to what they're paying into a policy as possible. And the reason why the objection we'll often hear around this is that if you have a higher base premium, say I'm paying in $10,000 and I have a $5,000 base premium, meaning 50% of my total payment is going toward the base premium component, which means I'll have very close to 0 of that $5,000 in cash value in the first year, probably the first and second year. But why would I want a higher base premium which sacrifices early cash value? Why is that? Well, the objection again around that specific topic is that a higher base premium potentially results in greater long-term cash values. The reason for this is when you look at a cash value life insurance policy, I've got the guaranteed component of 4%, and then I have the surplus, the dividends, everything above and beyond the guarantee. When I look at dividend treatment on a life insurance policy, it is actually more favorable to base premium dollars than it is PUA dollars. So as time passes, there's a chance, especially if dividends go up, that my policy could have more cash value long term. Here's my thoughts on it. 1, if dividends do go up and I potentially have more money, it's going to take somewhere between 30 and 40 years before that becomes a reality. So first, that's a lost opportunity cost. I have to wait 30 to 40 years, and if I do have more money, it might be between 0.1 to 0.2%, very minimal. And then second, here's the big point, in my opinion, is when you look at reality, actual policies that have lived the test of time, policies with minimum premiums. Even though they have not illustrated the strongest cash values, we've seen them consistently produce the strongest cash values. And what's very interesting is if you look at the illustration and focus on the guarantees, what is guaranteed to you, the policyholder, a minimum base premium will give you more cash value almost 10 out of 10 times. So around the objection of we should have a higher base premium, that would be something we would regard as FUD and is not true. The second objection / question we receive sometimes is that a low base premium is of a scarcity mindset and a high base premium is of an abundance mindset. I'm not really sure what that means, simply because when we look at actual cash value life insurance policies with minimal base premiums have produced greater cash value short-term and long-term, especially when you look at the guaranteed values. So those are my only thoughts on that objection. Number 3, a minimum base premium can harm the integrity of a whole life insurance policy. I'd assume that this objection has to do with the modified endowment contract on a life insurance policy, because a lot of times individuals will run into issues with illustrations or actual policies when they reduce the base premium. You see, the thing is, when you look at the actual MEC laws of a life insurance policy, a MEC can occur in any situation. And what often happens, call it the unseen, is we're often shown an illustration that we're told it's not going to MEC, and then in reality it MECs 10 years, 15 years, 20 years down the road. Why? We actually had a case once. It was not a policy we put in force, but someone came to us. They had bought a policy several years ago, and when they purchased it, they were told it would not MEC. They have been paying into it at the exact schedule they originally anticipated. They received the in-force illustration, and they're told, hey, when you hit year 18, you're going to MEC. And he says, why? Like, I'm doing the exact same thing that I did from day one, exactly what I signed up for. Well, what had happened in that particular situation is dividend rates had come down since he purchased the policy, which means the death benefit appreciated at a lesser rate. If you've seen any of our MEC content, do you remember what the MEC limit has a direct relationship to? Age and death benefit, and it goes beyond the first 7 years. So Whenever we set up a policy, what is very critical to do here, and we do this with everyone, is MEC test the policy based off of more than just the present dividend rate. Doesn't ever MEC based off of a conservative dividend, based off of the guarantees. I'm getting into the weeds here. I do that a lot. My point is, if you hear the objection or the question that a minimum base premium can damage the integrity of a life insurance policy because it might MEC, it's not true. It's really just a means of digging into the policy and designing it in a manner where we can optimize the cash value. Because the name of the game is maximizing the cash value. Think of it this way. It's the integrity of your cash. If you're putting money into a policy, because this is your money, not ours, not the agent's, it's your money going into a policy, how do we optimize it from day one throughout the life of the policy? And minimum base premiums do that if and only if constructed properly. Number 4, you should not use a blended term / PUA rider. So what this is one of my favorite riders to attach to whole life insurance policies actually. A blended PUA / term rider consists of money going into PUAs and then OYT. OYT stands for 1-year term. Really, how this rider works, it's attaching a term rider to a life insurance policy, but it is 1-year renewable term. What that means, 1-year renewable, is it renews every year, the cost renews every year. So as I grow older, that cost does increase. The thing is, how those riders actually work when we construct them properly is the term amount. So if I start with $1 million, each year goes $1 million to $900,000 to $800,000, it decreases over time. Often the net cost decreases along with the face amount. And that's based off of the current term expenses and often the guaranteed expenses as well. We've got a quick example up here on the screen where we see a policy with that 1-year term rider. You see the cost per unit increase over time. That's specifically the term cost. But then you see the net cost. That's what I would pay out of pocket. What happens with that? It decreases over time. So interesting. And you know, the thing is, when we look at these riders with a whole life insurance policy, I was actually talking with the actuary we work with, and I mentioned this to him around 1-year term riders, how we construct policies. We do it because it builds in flexibility, you get stronger guarantees, all that good stuff. And his comment was, you know, Steve, that does maximize cash value. And kind of the inside joke when I worked with other actuaries was that's what we called actuary's choice. That was the policy design we selected in order to maximize cash value. And there it is from an actuary. And that was actually from Scott Witt. You may have seen some of our podcasts with him. He is a fee-only insurance advisor that consults with individuals on how to maximize the cash value on a life insurance policy. So that was interesting when we got that. So back to the objection that a blended PUA rider or 1-year term rider can harm the performance of the policy, or we don't want to go with it. I would say that that is not true when you look at the actual net results, the real data on a life insurance policy. We want to make sure everything's transparent and see that, but I would just look for the data. This way we can make a decision on our own. Objection number 5. I was told that I should go with a small to medium-sized life insurance company. So when selecting the right insurance company for a whole life insurance policy, how do I choose the right company? Because there's a lot of variables that go into it. There's a lot of pros, benefits to smaller companies. Here's my big thing. How do I set the policy up for flexibility? That's important. I want to make sure the actual product I'm selecting is flexible based on my needs as the consumer, my needs and or wants. But when you look at an actual insurance company, we've got financial ratings, company size, all that good stuff. The biggest selling point, in my opinion, is when we look at policies that have lived the test of time, actual results, not illustrations. We're talking real-time performance that has occurred for individuals and corporations, companies that have consistently provided proof of performance. Here's what our policies actually did over time. I've seen 4 consistently do that: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Those guys, in terms of just maximizing death benefit and cash value over time, the highest internal rates of return, we've seen that with those guys. Not to say other companies have not done that, but the big four, the four major mutuals, have consistently done so. So that's the biggest selling point in my opinion. And remember, our focus is to optimize the cash value and death benefit on a life insurance policy. How do I design it properly for minimum premiums, maximum cash, flexibility, and then how do I position myself with the right company that's going to give me the best bang for my buck? And we've seen that the four major mutual companies have done so. So we covered a lot of material there. If you are interested in a high cash value life insurance policy, a dividend paying whole life insurance product, how do I make the right choice? Maybe you're watching this video and several others and you're saying, okay, how do I actually pick the best option for myself? Well, there's a couple ways to go through this process. One, you can certainly view our channel. If you like the details, to dig into everything, to say, hey, how do I maneuver the base premium? What companies allow me to add PUAs at leisure? What are the different loan rates? Direct, non-direct recognition. I could go on and on about the details that we have on our channel. Feel free to view, do as much research as you'd like. Two, can talk to a fee-only insurance advisor. I would recommend Scott Witt. He is an actuary. His company focuses on teaching individuals how to maximize cash value life insurance policies, to optimize the cash value, really looking at the actual performance, not always the illustrated, which is interesting. He is a fee-only insurance advisor. He does charge for his services. He is not compensated in any way for the policy sale. So you do have that non-biased or disinterested third party. So we do have to pay him a fee, but you will get great advice from him. Or three, what we can do is copy the people that already have it figured out. You know, when you look at big banks, corporations, and wealthy individuals, they tend to use certain insurance companies that we mentioned earlier and design policies for maximum cash value upfront, which, by the way, produces maximum cash value over the long haul, again, focusing on actual performance. So as always, I hope that this helps. Reach out with any questions, and we hope to talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.